Good afternoon, everybody, and welcome to another episode of the Tip Share. Do you know everything about your restaurant assets? Not just what they are, but how your restaurant assets interact with other critical elements of that indispensable, indisputably important financial report, the balance sheet? During today's episode, we are going to dive into our all-in-one resource on restaurant assets. We'll cover how assets of a restaurant are defined. We'll talk about the difference between restaurant long-term versus short-term assets. We'll discuss how assets in place impact assets of a restaurant. And lastly, we'll talk about the key components of your balance sheet, your liability, your equity, and your assets. So what exactly are the assets of a restaurant? Assets are everything your restaurant owns and uses to run its operations, from food to real estate to equipment and more. These are all considered restaurant assets. All of your assets are listed on your balance sheet in order to keep track of their values. It helps to further define your assets into short-term and long-term categories. Each type has unique characteristics, and knowing how to track them provides a clear, concise financial picture for your business. So let's get into long-term versus short-term assets. Now, not every restaurant classifies short-term assets the same, but here's a good benchmark to follow. Short-term assets are any asset that will convert to cash within the next 12 months. This includes cash, but also inventory and accounts receivable. So some examples might include merchandise, cash on hand, your food inventory, and your stocked alcohol. Now, long-term assets, meanwhile, are all assets expected to be owned and still in use within 12 months. So this might include real estate, furniture, equipment, which could be everything from ovens to POS equipment, and even your longer-term financial investments like bonds. So these are all considered your long-term assets of a restaurant. Now, some of you may be wondering what are the reporting differences between these short-term versus long-term assets. The distinctions between the two are critical into understanding your financial reporting. Depreciation is a vital aspect that impacts long-term assets, but it does not impact short-term assets. So remember, your short-term assets will convert to cash within a year. This simple fact makes evaluating and reporting on their actual and projected value easier. If your restaurant currently has $3,000 in accounts receivable, that equates to $3,000 in short-term assets. Now, the same principle applies to food costs. Whatever amount of food for recipes and menu preparation you have on hand is what you'd want to report as a short-term asset, even though you'd typically sell more than that on your menu. All right, on the other hand, long-term assets are accounted for differently because of depreciation. So think of 12 months as the cutoff for this depreciation. Your long-term assets gradually reduce over each accounting period. We'll say every 2 months or quarter or whichever period is used for your asset depreciation. Let's say you buy a freezer for $6,000 in January. By March, that value decreases. By June, it depreciates even further. Equipment, furniture, and other hard long-term assets are reported with regular depreciation factored in. Other long-term assets, like bonds, to take from our previous example we mentioned earlier, are usually reported at their current market value. I mean, it's hard enough for the talking heads on TV to predict the Dow Jones, let alone a busy restaurant manager. Now let's put it all together through the balance sheet. Your restaurant's balance sheet is a clear picture of your business's financial standing. The balance sheet starts with the assets of your restaurant. Then your liabilities are factored in, which includes accounts payable, long-term debt, and other expenses. Now subtract your liabilities from your assets and you have your equity, essentially the profit or loss from your business. Another way to think about equity is your net assets. When your liabilities exceed your assets, it's obviously time to change your course of action. As a bonus, I recommend you check out our comprehensive article on understanding the balance sheet for a deeper dive into learning more about the balance sheet and what all of this means. You can find it on our website at www.rasiusa.com. So now that you've got a good grasp on the assets of your restaurant, it's time to put this knowledge to use and efficiently run your business. With RASI's automated software, we'll help you keep track of short-term and long-term assets, whether you need assistance with depreciation, accounting, balance sheets, or more. Thank you so much for listening to another episode of the Tip Share, and as always, we will see you next week.